If you think the retirement system in America is stable, think again, because a wave of changes is coming, and the warning signs are already flashing. Over the past few months, analysts, economists, and even former U.S. Treasury officials have been hinting at something big, something almost nobody in the general public is prepared for, and it all leads to one alarming conclusion. Backhand index pointing right, another U.S. credit downgrade is becoming more likely and faster than people expect. Now here's why this matters for everyday Americans, especially those planning to retire or already living on fixed income. A credit downgrade doesn't just hurt Wall Street. It hits your mortgage rates, your credit card interest, your taxes, and even your Social Security stability. It makes the dollar weaker, inflation harder to control, and the government more desperate to squeeze money from taxpayers. In short, a downgrade is not just a headline, it's a warning about your financial future. And that's exactly why this video matters. Because today, we're breaking down the signals pointing toward a potential downgrade, how it impacts you, and the smartest moves Americans can make before it happens. Welcome to Tax Hack Pro, where we break down complicated financial changes and help you stay one step ahead of the system. Over the last year, several major credit rating agencies have quietly issued warnings about America's long-term financial direction. These agencies don't make dramatic statements, and they rarely move quickly, which makes their recent concerns even more important to pay attention to. Here are the key factors they're watching. 1. Rising federal debt levels. The national debt is increasing at a pace that is beginning to worry long-term investors. It's not just the size of the debt, it's how quickly it's growing. The U.S. is taking on new obligations faster than the economy can reasonably support, and rating agencies notice this imbalance immediately. 2. Higher interest costs. When interest rates stay elevated, the government ends up paying significantly more just to service existing debt. This means billions of dollars are going toward interest payments instead of programs like Social Security, Medicare, defense, and infrastructure. Over time, this imbalance becomes a signal of financial strain. 3. Political gridlock. Another quiet but important factor. International rating agencies want stability, but the U.S. has seen repeated government shutdown threats, debt ceiling standoffs, and last-minute temporary agreements. This political unpredictability reduces confidence in long-term fiscal planning. 4. Slowing economic momentum. While the U.S. economy remains relatively strong, the forward outlook is less certain. Slower growth combined with rising debt is one of the clearest reasons a downgrade can occur. All of these issues create a scenario where rating agencies begin asking a difficult question. Can the U.S. realistically manage its future financial obligations without significant changes? And if the answer becomes uncertain, that's when a downgrade happens. A U.S. credit downgrade isn't just a financial headline, it's a shift that influences nearly every part of the economy. Most people think it affects only Wall Street or major institutions, but the reality is different. A downgrade quietly reaches into the daily lives of ordinary Americans, especially families on tight budgets and seniors living on fixed income. Here's how it affects you directly. 1. Higher interest rates on loans and credit cards. A downgrade sends a message to global markets that lending to the United States is riskier than before. When risk rises, interest rates rise with it. That means higher credit card APR, higher auto loan rates, higher personal loan rates, higher mortgage rates, higher refinancing costs. Even if you personally have excellent credit, you still pay more because lenders base rates on national financial conditions, not just individual credit scores. 2. More pressure on Social Security and Medicare. When debt servicing becomes more expensive, the government is forced to redirect money from other programs. This increases pressure on Social Security, cost of living adjustments, Medicare, funding federal benefits for seniors. It doesn't mean benefits disappear, but it does mean those programs become harder to maintain without further tax increases or policy adjustments. 3. Higher costs for everyday living. A weaker national credit rating can influence inflation indirectly. Why? Because as borrowing becomes more expensive for the government, some of those costs flow back into transportation, food supply chains, housing, energy. This doesn't cause sudden spikes, but it adds steady upward pressure on prices, exactly the kind that makes fixed budgets feel tighter over time. 4. Stock market and retirement account volatility. Most 401(k)s and IRAs are tied to U.S. bonds and equities. When confidence in the government's credit rating falls, markets can become more volatile. For retirees or near retirees, this volatility matters because withdrawals become riskier, portfolio values can fluctuate, long-term returns may soften. This is why staying informed is essential. It helps retirees plan ahead instead of reacting after changes occur. 5. Local governments feel the impact too. A national downgrade can trigger ripple effects for cities and states. This can lead to higher municipal borrowing costs, delayed infrastructure projects, reduced public services, increased state taxes or fees. It's a chain reaction, and it starts at the top. With all these quiet but powerful impacts, a potential downgrade becomes more than a financial event. It becomes a shift that affects households, retirement plans, and everyday expenses. Economists, credit agencies, and financial analysts don't issue warnings without evidence. They track dozens of long-term indicators that signal when a country's credit strength is beginning to weaken. Today, several of those indicators are pointing in the same direction, and that's why talk of a downgrade is increasing. Below are the clearest warning signs experts are monitoring. 1. Debt growing faster than the economy. The U.S. economy continues to grow, but not at the same pace as federal borrowing. When debt expands faster than national income, it creates a long-term imbalance. This is concerning because it reduces the government's financial flexibility, it increases reliance on borrowing, it limits the ability to respond to future emergencies. Agencies like Moody's and Fitch watch this ratio closely. 2. Rising interest payments consuming the budget. The U.S. government now spends hundreds of billions of dollars each year just on interest payments, not paying down the debt, just maintaining it. Experts point out that interest payments are now one of the largest federal expenses. This reduces funding available for Medicare, Social Security, and defense. It signals a growing vulnerability in the budget when interest becomes one of the biggest bills. It's a clear sign of strain. 3. Short-term budget fixes instead of long-term solutions. Rating agencies monitor how governments handle financial disagreements. They've noted repeated debt ceiling standoffs, temporary budget extensions, last-minute political agreements, a lack of long-term fiscal planning. This creates unpredictability, and credit agencies don't like unpredictability. They prefer stable, long-term budgeting. 4. Increasing dependence on foreign investors. A significant portion of U.S. debt is purchased by foreign governments and global investors. Recently, some of these investors have reduced their long-term purchases. This doesn't cause an immediate crisis, but it does raise questions like, will global demand for U.S. debt weaken? Will the government need to offer higher interest rates to attract buyers? Could this reduce financial stability over time? These shifts matter when agencies evaluate national credit strength. 5. Inflation moderating, but not fully under control. Inflation has cooled, but analysts emphasize that it hasn't yet returned to pre-pandemic stability. If inflation remains unpredictable, it places additional pressure on the government's borrowing strategy. A rating agency considers this a sign that long-term financial predictability is uncertain. Costs for essential programs could increase. Future rate changes may be necessary. All of these factors add weight to downgrade discussions. 6. Slower long-term economic growth forecasts. Even when the economy is stable today, analysts focus heavily on the next 10-20 years. Recent forecasts show modest but slower growth expectations. Lower future growth makes it harder to reduce debt, support federal programs, maintain financial strength, avoid future tax increases. This long-term outlook is a key part of downgrade risk. Taken together, these indicators don't guarantee a credit downgrade, but they do signal why experts are preparing for the possibility. A U.S. credit downgrade has some of its strongest and most immediate effects in the housing sector. For many Americans, especially seniors who depend on stable monthly expenses, these changes can have real financial consequences. Below is a calm, clear breakdown of how a downgrade impacts homeowners, renters, and retirees. 1. Mortgage rates can increase when the government's credit rating goes down. Borrowing becomes more expensive across the board, including for banks and mortgage lenders. This often leads to higher 30-year mortgage rates, higher refinancing rates, fewer affordable housing options, reduced home buying activity for seniors still paying off a mortgage, or those hoping to downsize. Higher interest rates make long-term planning more challenging. 2. Home prices may slow or soften when mortgage rates rise. Fewer people qualify for new loans. This can reduce demand for homes and slow down price growth. For seniors planning to sell their home, relocate to a smaller property, move to a retirement-friendly state, a softer housing market may affect how much equity they can access. 3. Renting becomes more expensive. A credit downgrade adds pressure to the housing market overall. That means higher costs for property developers, more expensive construction loans, increased insurance expenses, higher operational costs for landlords. These added costs typically get passed on to renters, including seniors moving into apartments, retirement communities, or assisted living facilities. 4. Reverse mortgage rates may rise. Many older homeowners rely on reverse mortgages as a retirement income tool. However, these programs also depend on interest rate conditions. A downgrade can cause higher initial fees, higher interest charges, lower net payouts to homeowners. This reduces how much value a senior can extract from their home over time. 5. More pressure on local housing programs. A national downgrade impacts state and local governments too. When their borrowing becomes more expensive, they often scale back support programs. This can affect affordable housing developments, rent assistance programs, senior housing grants, community support initiatives for older Americans relying on these services. Even small policy changes can make a noticeable difference. 6. Property taxes may increase in some areas if local governments face higher borrowing costs and reduced federal support. Many try to recover revenue through property taxes. This disproportionately affects seniors who live on fixed income, own older homes, cannot increase earnings to match rising costs. Even small property tax increases can disrupt a retirement budget. A credit downgrade creates a housing environment that is less predictable and more expensive. While not catastrophic, it introduces financial pressures that retirees should monitor closely, particularly those planning major housing decisions in the next few years. A U.S. credit downgrade doesn't just influence interest rates and housing. It also affects the broader investment landscape, including retirement accounts like 401(k)s, IRAs, Roth IRAs, and pension funds. For seniors and pre-retirees who rely on these savings, it's important to understand how these changes unfold. 1. Increased volatility in stocks. The stock market responds quickly to any news that suggests long-term financial instability. A credit downgrade can lead to temporary market drops, increased day-to-day volatility, more cautious corporate investments, slower long-term growth in certain sectors. This doesn't mean retirement accounts will collapse, but it does mean their value may fluctuate more than usual. 2. Bond markets may react strongly. A downgrade sends a message to global investors that U.S. debt carries slightly more risk than before. This can affect U.S. Treasury yields, corporate bond rates, municipal bond performance, fixed income retirement portfolios. Since many retirement accounts hold bonds as safe assets, these shifts may impact overall account balance and stability. 3. Lower returns for traditional retirement portfolios. Most retirement portfolios follow a mix of stocks and bonds. When both markets experience uncertainty, long-term returns can soften. For retirees making withdrawals, this means less cushion for market downturns, a greater need for careful withdrawal planning, higher importance of maintaining an emergency reserve. Managing stability becomes more important than chasing high returns. 4. Pension funds may face new challenges. Pension systems, especially public ones, depend heavily on predictable investment returns. A downgrade can reduce the value of their bond holdings, increase funding pressure, lead to future adjustments in contributions or benefits. Retirees with traditional pensions should monitor updates from their pension board or plan administrators. 5. An increase in flight to safety behavior. When uncertainty rises, investors often shift toward cash reserves, short-term treasury bills, money market accounts, low-risk funds. This reduces market liquidity temporarily and can slow overall growth, which affects long-term retirement projections. 6. Withdrawal timing becomes more sensitive for retirees taking required minimum distributions, RMDS, or regular withdrawals. Market volatility can mean withdrawing during dips reduces long-term balance. Planning becomes more important. Maintaining a diversified strategy is essential. Small timing adjustments can make a meaningful difference. What this means for retirees: a credit downgrade does not mean retirement accounts are in danger. Rather, it signals that returns may be less predictable, market cycles may be more frequent, long-term planning becomes even more important. A U.S. credit downgrade doesn't just ripple through the stock or bond markets. It also has the potential to influence essential federal programs that millions of Americans depend on every single day. Social Security, Medicare, and other federal benefits are funded in part by government obligations and the broader fiscal health of the nation. While these programs are generally considered secure, a downgrade sends a signal to policymakers and investors that borrowing costs are increasing and that government debt is slightly riskier than previously assessed. This may indirectly influence how funds are allocated in the future, especially when federal budgets are under pressure. For Social Security recipients, the immediate impact may be minimal. Your monthly checks are unlikely to stop. However, higher interest rates on government debt could push the Treasury to rethink strategies for financing Social Security's long-term obligations, potentially affecting future benefits, cost of living adjustments, COLAs, or eligibility timelines. Medicare and other federal health programs may experience a similar, if subtle, effect. Increased government borrowing costs can put pressure on funding allocations, meaning that policymakers may need to consider adjustments in premiums, coverage structures, or reimbursement rates over the long term. For seniors who rely on both Social Security and Medicare, understanding the potential chain reaction is crucial. Even small adjustments in benefits, premiums, or inflation protections could have meaningful consequences for household budgets. Retirees should take this moment to review their financial plans, understand how federal benefits fit into their overall income strategy, and consider contingency measures to preserve stability in a potentially shifting fiscal environment. Essentially, while no program is at immediate risk of collapse, a downgrade acts as a warning bell. Now is the time to be proactive rather than reactive. Strategic planning, diversification, and keeping abreast of policy discussions can make the difference between maintaining financial security and being caught off guard. A U.S. credit downgrade has far-reaching implications for the housing market, mortgages, and personal credit, all of which are deeply connected to how Americans borrow and spend. When the nation's credit rating drops, borrowing costs rise almost immediately because investors demand higher yields to offset increased risk. This directly affects mortgage rates for new homebuyers and those looking to refinance existing loans. For families in Florida, especially those already feeling pressure from rising property taxes, higher mortgage rates could compound financial stress. Imagine locking in a home loan at a rate that climbs significantly over just a few months. Monthly payments can spike, potentially stretching household budgets to their limits. Homebuyers may see reduced affordability, slowing demand and potentially putting downward pressure on home prices in the short term. On the flip side, sellers may face hesitation as buyers become more cautious, creating uncertainty in local real estate markets. Beyond mortgages, higher interest rates trickle down to other types of credit, including personal loans, car loans, and credit cards. Those relying on variable rate debt may find themselves paying more each month, while prospective borrowers could delay important purchases, affecting consumer confidence and economic growth. For retirees and fixed-income households, this is particularly critical. Limited financial flexibility makes it harder to absorb rising costs. At the same time, homeowners with substantial equity may see the value of their investments fluctuate, influencing decisions about selling, downsizing, or leveraging home equity. In short, a credit downgrade doesn't just affect Wall Street, it hits Main Street, impacting the everyday financial choices of millions of Americans. For viewers of Tax Hack Pro, understanding this connection between national credit ratings and local housing costs is essential because it informs decisions on buying, refinancing, or even budgeting for property taxes, insurance, and unexpected expenses. Strategic planning now can help families weather the ripple effects of a downgrade while maintaining control over their financial future. A U.S. credit downgrade doesn't just impact mortgages and interest rates, it sends shockwaves through the stock market, affecting retirement portfolios, investment strategies, and long-term financial planning. When creditworthiness drops, investor confidence can wobble, leading to sharp market fluctuations as stocks, bonds, and other assets react to perceived risk. For average Americans, this translates into swings in 401(k)s, IRAs, and other retirement accounts, often at the worst possible time. For Florida homeowners, retirees, and working families tracking their net worth, seeing account balances dip suddenly can be unsettling, creating pressure to make impulsive financial decisions. But reacting too quickly, selling in a panic, can lock in losses and undermine years of careful investing. On the other hand, those who understand the dynamics can strategically navigate market volatility, adjusting allocations, diversifying holdings, or even taking advantage of lower prices to strengthen long-term portfolios. For viewers of Tax Hack Pro, it's critical to connect the dots between national fiscal policies, credit ratings, and personal investments, because these macroeconomic shifts don't stay abstract. They hit retirement plans, college savings, and emergency funds. Moreover, volatility often impacts consumer confidence, which can feed back into housing markets, local economies, and spending patterns. Families may delay major purchases, reduce discretionary spending, or rethink financial goals, all while keeping an eye on the stability of their homes and neighborhoods. The key takeaway is that understanding these financial ripple effects, from government debt levels to interest rates, property taxes, and stock market performance, allows individuals to make informed, proactive decisions, rather than reacting emotionally to headlines. With the right guidance, strategies, and timing, it's possible to protect your investments, preserve financial security, and continue building wealth even during periods of uncertainty. In essence, being informed, prepared, and adaptable is the difference between financial vulnerability and financial resilience. For viewers of Tax Hack Pro, The question isn't just understanding potential property tax eliminations or credit downgrades. It's about actionable strategies that protect your home, your savings, and your long-term financial future. First, homeowners should carefully track property valuations, local tax policies, and any legislative proposals that could impact homestead exemptions or other tax relief measures. Being proactive rather than reactive is key. Next, diversify your financial plan. Maintain an emergency fund, review retirement accounts, and consider investment strategies that hedge against market volatility, ensuring your portfolio remains resilient even if economic shocks occur. Tax planning itself is another crucial lever. Understanding deductions, exemptions, and credits, from mortgage interest to medical expenses and energy-efficient home improvements, can provide meaningful annual savings, reducing the stress of rising costs. Additionally, families should assess insurance policies, refinancing options, and any municipal programs designed to support fixed-income residents, retirees, or first-time homeowners. Knowledge is power, but timing matters too. Staying informed about the 2026 vote on property tax reforms in Florida and similar policy changes across the U.S. allows homeowners to plan ahead, protect their assets, and avoid last-minute financial scrambling. Most importantly, don't navigate these complex decisions alone. Consult financial advisors, tax professionals, or the expert insights shared by Tax Hack Pro, which distills high-level policy changes into practical, everyday steps that make sense for real households. Ultimately, the combination of awareness, preparation, and strategic action is what ensures that families remain in control of their homes, their finances, and their futures, no matter how unpredictable the economy becomes. From rising property taxes to stock market shifts and evolving tax laws, the message is clear. Staying informed, proactive, and strategic is the best way to secure stability, safeguard your investments, and confidently move forward in a world of financial uncertainty. For Tax Hack Pro viewers, this is more than advice. It's a blueprint for protecting what matters most: your home, your savings, and your peace of mind.